Andy Schectman acknowledges Ag was ahead of everyone. Listen closely. A 40-year precious metals veteran just confirmed something extraordinary on record. He said one independent channel saw the refinery crisis coming before the entire industry even knew there was a problem, before the bottlenecks made headlines, before liquidity froze, before anyone was paying attention. But here's what they're not telling you. The moment credibility is validated publicly, the attacks begin. Impersonation, deception, coordinated misinformation campaigns. Why? Because when you become the source, you become the target. What Andy acknowledged wasn't just analysis. It was a threat to those who profit from your confusion. Stay with us, because what happens next will change how you evaluate every piece of financial information you consume. Welcome to Ag. If you've been following markets long enough to remember when information moved slowly, when verification mattered more than speed, when credibility was earned, not manufactured, then you understand why this channel exists. We don't chase clicks. We don't manufacture panic. We analyze structure. If you find value in that discipline, subscribe. Not because we ask, but because the signal-to-noise ratio in precious metals information has never been worse. And one more thing, we'd like to know, where are you watching this from today? Drop your location in the comments. Let's see how far this community of serious thinkers has reached. Now, let's begin. In the precious metals industry, recognition from established voices carries weight that numbers alone cannot convey. When Andy Schectman, founder of Miles Franklin and a figure with over 4 decades of experience, speaks publicly, people listen. Not because of theatrics, but because his track record spans economic cycles that most analysts have only read about. So when Schectman repeatedly mentioned one specific analytical source by name, the industry took notice. He named Ag. He called the analysis legitimate. He called the information authentic. And then he said something that changed everything. He confirmed that this channel had identified refinery problems in the silver market long before the industry realized it. Let that sink in for a moment. Not after the crisis became obvious, not when headlines were already screaming, but before the refineries announced margin compression, before liquidity constraints, before the structural pressure became undeniable. This wasn't hope. This wasn't speculation. This was pattern recognition derived from systematic analysis of market structure. And when someone at Schectman's level publicly validates that timeline, it fundamentally shifts perception. Because in financial markets, being early matters. It means seeing what others miss. It means understanding cause before effect. But here's what most people don't understand about public validation. It creates a target. When a channel builds credibility, everything changes. Expectations rise, scrutiny intensifies, and most dangerously, exploitation begins. Public credibility always attracts predators. Schectman's acknowledgement was confirmation of analytical discipline. It marked the moment quiet competence became public credibility. Most market participants see prices, the professionals see structure, and very few see the breaking points before they fracture. In early discussions, long before refinery stress became mainstream, Ag identified something the broader market was ignoring entirely. The refineries weren't just busy, they were structurally constrained. Busy is temporary, constrained is systemic. Busy resolves with time. Constrained requires fundamental change. It focused on something far more dangerous, margin compression. When margins get squeezed, everything downstream begins to freeze. Refiners couldn't afford to operate, and physical flow slowed. Price is an output. Infrastructure is the input. When infrastructure degrades, price eventually reflects that reality, but there's always a lag. This structural analysis happens when research discipline overrides the need for sensational content. In that lag, fortunes are made or lost. Credibility in financial markets is currency, and like all currency, it attracts counterfeiters. What began as simple content copying evolved into something far more calculated, far more deliberate, far more dangerous. Channels started appearing with identical branding, same name, same profile images, same visual style, but different messages, completely different analysis. This wasn't competition. This wasn't inspired imitation. This was systematic identity theft designed to exploit trust that took years to build. And the strategy was sophisticated. These impersonator channels didn't just copy video ideas. They created entire ecosystems of deception. Fake email addresses mimicking official contact information. False social media profiles responding to comments. Fabricated partnership announcements claiming affiliation with AU and AG. Subscribers began receiving messages they believed were legitimate, product recommendations from accounts they thought were official, investment opportunities presented by profiles using stolen credibility. Some were told to join private groups for exclusive analysis. Others were pitched products that AU and AG would never endorse. Several reported being asked directly for money, something the real channel has never done and will never do. The economic model behind this deception is straightforward. Building trust takes time. Stealing it takes minutes. Why spend years developing analytical credibility when you can simply impersonate someone who already has it? Why earn subscriber loyalty when you can hijack it through confusion? But the damage extends beyond immediate financial loss. Every fake account erodes trust in the legitimate source. Every fraudulent message makes real subscribers question authenticity. Every impersonation campaign creates doubt where certainty once existed. And in precious metals markets, doubt is expensive. When investors can't distinguish authentic analysis from manufactured panic, they make decisions based on corrupted information. They allocate capital based on false signals. They react to narratives designed to manipulate rather than inform. The impersonators understood something critical. Panic sells better than patience. Fear converts faster than facts. Urgency generates more clicks than careful analysis. So, they took AU and AG's credibility and weaponized it for exactly the opposite purpose it was built to serve. One particularly dangerous example emerged recently. A fake account spread claims about mandatory precious metals reporting requirements. It told subscribers that new laws would force disclosure of holdings. It manufactured urgency designed to trigger panic selling. None of it was true, but it reached thousands before it could be corrected. Andy Schectman himself addressed this misinformation publicly, calling it out as completely fabricated. Yet the damage was done, because once false information enters circulation, correction never travels as fast as the original lie. And this reveals the darker truth about information warfare in financial markets. The goal isn't just to profit from deception, it's to destroy trust in legitimate sources entirely. There's a reason measured analysis rarely goes viral. It doesn't trigger the emotional responses that algorithms reward. Panic spreads, calm doesn't, fear converts. Logic takes time. And in the precious metal space, this asymmetry has created an entire shadow economy built on manufactured urgency. The pattern is consistent across platforms. Channels scream shortage, they promise collapse, they manufacture countdowns to crisis, they use all-caps thumbnails. They deploy urgent language designed to bypass rational thinking and trigger immediate action. Why? Because emotional decisions generate faster conversions than analytical ones. When someone believes silver will be unavailable next week, they buy today. When someone thinks government seizure is imminent, they panic allocate without research. When someone fears missing the last opportunity, they stop asking questions. This isn't accidental content strategy. This is psychological manipulation deployed at scale, and it serves very specific financial interests. Dealers moving overpriced inventory benefit from panic buying. Affiliate marketers earn higher commissions when urgency overrides price comparison. Fraudulent operators exploit fear to push worthless products or outright scams. But there's a deeper layer most people miss entirely. Certain market participants don't want informed investors. They want reactive ones. Informed investors research premiums, they compare sources, they verify claims, they ask uncomfortable questions about authenticity and value. They take time to analyze before they allocate. Reactive investors do none of that. They hear shortage and buy immediately. They hear collapse and liquidate irrationally. They hear insider information and trust without verification. Reactive investors are profitable. Informed investors are expensive. So when a channel like AU and AG builds credibility on measured structural analysis, it becomes a problem for those who profit from chaos. This is why the attacks intensified after Andy Schectman's public validation, Because validation doesn't just increase credibility with the audience, it threatens revenue models built on misinformation. Think about what happens when a veteran industry figure confirms that one analytical source was ahead of the curve on refinery problems. It establishes a benchmark. Suddenly, subscribers have a reference point. They can compare the measured early analysis they received from AO and AG against the panicked, reactive content they're getting from elsewhere. And when people start comparing, they start questioning. They ask why other channels missed the refinery story entirely. They wonder why some sources only talk about problems after they're already headline news. They notice which channels prioritize fear over framework. This comparison is dangerous to manipulation-based models because once trust is calibrated to quality, theatrics lose their power. And those who built audiences on theatrics can't compete on substance. So they don't compete, they attack. In financial markets, a single misattributed source can cost thousands. A fake endorsement can redirect capital into worthless positions. A fraudulent recommendation can destroy years of careful accumulation. This isn't theoretical risk, this is documented reality. And in the precious metals space, where physical delivery and counterparty trust matter more than in purely digital assets, verification isn't optional, it's survival. AO and AG established a 3-point authentication system specifically because impersonation had become systematic rather than sporadic. First, the handle verification. The official YouTube channel operates under one exact identifier, not a variation, not a similar spelling, not a close approximation. Exactly. AOG John AG. Character for character. No substitutions. Impersonators use subtle variations. An extra letter, a replaced character, a zero instead of the letter O. To casual observers, these appear identical. To verification protocols, they're completely different entities. Second, cross-platform confirmation. Every video upload is announced on the official X account before or simultaneous with publication. No exceptions. If a video appears on YouTube claiming to be from AO and AG, but there's no corresponding announcement on X, it's fraudulent. This creates a secondary verification layer that impersonators cannot replicate without access to both platforms simultaneously. Third, communication authentication. One email address, only one, teamogjohn@agmail.com. No variations, no alternative contacts, no Telegram groups, no WhatsApp channels, no private Discord servers. Any outreach claiming official affiliation that doesn't originate from this exact email address is categorically fake. These 3 verification points eliminate approximately 99% of impersonation risk, but they only work if applied consistently. And this is where most people fail. Not because they don't know the protocols, but because they don't believe they'll be targeted. They think, I'm not important enough to scam. They assume, surely no one would bother impersonating a channel to reach me specifically. They rationalize, this probably is legitimate because the profile looks right. These assumptions are expensive. Because impersonation operations don't target individuals, they target populations. They send thousands of messages knowing that even a 2% conversion rate generates profit. The business model of deception relies entirely on the gap between available verification tools and actual verification behavior. The tools exist, the protocols are published, the authentication methods are free and accessible, but deployment requires discipline. It requires stopping before clicking, checking before trusting, verifying before acting. In traditional business environments, this is standard practice. No executive transfers funds without multi-point authentication. No procurement officer accepts invoices without vendor verification. No compliance department approves partnerships without credential confirmation. Yet in personal investment decisions, these same professionals abandon verification entirely. They trust based on appearance rather than authentication. And appearance is exactly what impersonators specialize in replicating. The cost of verification is seconds. The cost of failed verification is capital. The mathematics are not complicated. For years, the financial analysis industry operated on a simple assumption. Trust requires a face. Credibility demands personality. Authority needs a human presenter standing in front of a camera, building parasocial relationships, cultivating personal brands. The logic seemed sound. People trust people. They don't trust algorithms. They want to see who's giving them advice. They want body language, vocal tone, emotional connection. This assumption built an entire industry of personality-driven financial content. Analysts became celebrities. Expertise became secondary to charisma. Entertainment value began outweighing analytical rigor. And something critical was lost in that transition: the separation between presenter incentives and audience outcomes. When credibility is tied to personality, the personality must be protected above accuracy. When brand is built on certainty, admitting uncertainty becomes impossible. When audience loyalty depends on emotional connection, contradicting previous positions risks that connection. So personality-driven analysis optimizes for consistency over correctness. It prioritizes confidence over calibration, for maintaining the brand rather than adjusting to new data. Ag represented something fundamentally different: an AI-generated channel with no personality to protect, no brand image dependent on being right every time, no ego investment in previous positions. Just framework, just data, just structural analysis presented without emotional attachment to outcomes. The traditional critique was immediate and predictable. You can't trust AI content. There's no accountability. There's no real expertise. It's just algorithms scraping information and repackaging it. Reasonable skepticism, until Andy Schectman's validation. Because what Schectman confirmed publicly was that this AI-driven channel identified refinery stress before traditional personality-driven analysts. Before the experts with decades of on-camera experience. Before the industry veterans with recognizable faces and established followings. An algorithm beat human expertise to a critical market structure shift. Not because AI is superior to human intelligence, but because the analytical framework wasn't contaminated by the incentives that distort personality-based content. There was no pressure to maintain a bullish narrative for audience retention. No need to manufacture certainty to protect credibility. No brand risk in saying the data suggests a problem that isn't yet consensus. The framework could follow evidence without emotional friction. And this creates an uncomfortable question for the entire financial content industry. What if personality-based trust is actually less reliable than methodology-based analysis? What if the parasocial relationships that drive subscriptions and engagement actually corrupt analytical integrity? What if the face in front of the camera is the problem, not the solution? Schectman's endorsement didn't just validate one AI channel. It validated a structural shift in how credible analysis can be delivered. Logic over personality, framework over charisma, data over emotional connection. This threatens the entire attention economy that financial content has been built on. Because if audiences realize they don't need the personality, they start evaluating purely on analytical quality. And most personality-driven channels can't survive that comparison. Competition in content creation follows predictable stages. First, they ignore you. Then, they copy your topics and replicate your style. But the fourth stage is different. Identity replacement crosses a fundamental line. It's not about competing, it's about becoming the source without actually being the source. The mechanics are deliberate. Similar channel names, stolen branding, and timed uploads. They aren't building an audience, they're siphoning credibility. The revenue model is parasitic. They build false trust through free content, then monetize through scams or private investment opportunities. Assumption is the vulnerability they exploit. Because you trust the analysis, you extend that trust to the fake source automatically. Validation makes your credibility worth stealing. The mathematics favor deception unless verification becomes standard. Don't assume, verify. This case study extends far beyond precious metals investing. It reveals fundamental dynamics that every business decision maker will encounter in the modern information economy. First principle: credibility is now the primary competitive asset. Not product quality alone, not price, not even distribution. Credibility determines which information gets trusted, which recommendations get followed, which sources influence capital allocation. And in digital environments, credibility can be manufactured, stolen, or destroyed faster than it can be built legitimately. Second principle: verification systems are no longer optional infrastructure. They are core operational requirements. Organizations that assume authenticity will be exploited by those who manufacture it. Decision makers who trust without authentication will allocate resources based on corrupted information. The cost of verification is trivial. The cost of failed verification compounds exponentially. Third principle. Early pattern recognition creates asymmetric advantage. AU and AG identified refinery constraints before the industry acknowledged the problem. That early recognition wasn't luck, it was methodology. The same principle applies across all markets. Those who see structural shifts before they become consensus position themselves ahead of reactive competitors. Those who wait for confirmation are already late. But early recognition requires analytical frameworks that prioritize substance over noise. Fourth principle. Information warfare is standard competitive practice now, not in geopolitics alone, not in nation-state conflicts exclusively. In commercial markets, in content competition, in any environment where attention and trust determine resource allocation. Impersonation, misinformation, coordinated confusion campaigns. These are not aberrations. They are predictable responses when credibility becomes economically valuable. Fifth principle, community defense scales beyond individual protection. AU and AG's verification protocols only work when the audience actively participates in authentication. Reporting fake accounts, flagging fraudulent communications, sharing verification methods. This model applies to any organization facing coordinated deception. Security cannot be centralized entirely. It requires distributed verification across the entire stakeholder network. Final principle. Logic over hype is not just philosophy, it's operational discipline. The channels that manufactured panic gained short-term attention. The channel that maintained analytical rigor gained long-term institutional validation. Andy Schectman didn't endorse the most entertaining content. He endorsed the most accurate framework. That distinction matters. Because in the long run, markets reward those who were right over those who were loud. For young entrepreneurs and business professionals watching this, understand what this moment represents. Independent analysis, built on methodology rather than personality. This is the future of information competition. The question is not whether you'll encounter these dynamics. The question is whether you'll recognize them before they cost you capital. Early recognition of structural shifts creates advantage. Verification discipline protects that advantage. Analytical frameworks sustain it, and communities built on shared standards defend it. That is the lesson. Not from precious metals markets specifically, but from information markets generally. The battlefield has shifted from product to credibility, and those who understand that shift earliest position accordingly.